Today we will discuss about accounting standards and basics of accounting. Over the centuries, accounting has confined to the financial record keeping alone. That is the basic function of the accountant as well. But today's rapidly changing business environment has forced the accountant to reassess their roles and functions both within the organization and the society. So now the role of an accountant has changed from a record keeping member to providing vital information in decision making for the management. So here we will discuss about the basic fundamentals, objectives, characteristics and different branches of accounting, scopes and limitations. Accounting. Accounting is vital for any business. It helps you to keep an accurate record for all the financial transaction to understand how the organization is performing. In other words, we can say it is a process of reporting, recording, interpreting, summarizing, and entering and analyzing the data. So, the introduction of accounting helps the decision maker of a company to make effective choices by providing the accurate information of the financial statement of the business. So, next one is fundamentals of accounting. There are three components identified in fundamentals. One is assets, the second one is liabilities, and equity, owner's equity. So, assets, the economic value of an item which is possessed by the enterprise is referred to as assets. In other words, we can say those items that can be transferred into cash or that generates income for the enterprise is what is known as assets. So liabilities, the vice versa of the asset, that is the economic value of the obligation or debt that is payable by the enterprises to the other individual is referred to as liabilities. And then third one is owner's equity. We can say it with simple equation, that is asset minus liability is equal to owner's equity. Owner's equity means owners who had invested into the business or the net amount claimable by the owner from the business after paying all his debt is what is known as owner's equity. So next one is objectives of accounting. So these are the objectives. First one is to maintain a systematic record of business transactions. That is, in business, we have to keep a record of all the transactions in order to make the results as a accurate one. Okay, then so that with the help of the systematic records we can able to find out the profit and loss of the business. That is the second objective. And third one is to determine the financial position. Another important again in this objectives of accounting is financial position. That is, we have to say what is the position of the business concern, because so that the general outsiders or customers, stakeholders will be able to know the position of the business, so that it will be helpful for them to take some decisions over the investing into the business. Though, then the fourth one is providing information to the various users. As I said, it is useful for the businessman as well to improve their performance, and it is helpful for the stakeholders, it is helpful for the customers to know about the business position of the concern. The last one is to assess the management by analyzing the financial data and providing interpretation of the form of reports in accounting assets. Management will be able to take some quick decisions to operate effectively. Okay, next one is characteristics of accounting. It is to identify the financial transactions events. So we have to identify the transactions which is been recorded so far. So in order to measure those transactions, whether qualified or quantified, whatever it may be, we have to measure those transactions. And recording of transactions, in order, we have day-to-day transactions in our life, we have to make one journal, we have to post it to the ledger, and at the end we have to prepare the balance sheet. For those recordings of transactions, we have the accounting procedures as well. Then fourth one is classifying the transaction. Transactions are recorded in the books of original entry, that is journal or subsidiary books, that are being classified and grouped according to the nature of the postings, that has been separated in ledger account. Then summarizing means it involves presenting the classified data in a manner and in the form of statement which are understandable by the users. It includes trial balance, trading account, profit and loss account, and at loss balance sheet. So next one is analyzing and interpreting financial data. Results, that is the main thing we have to acquire in a business, right? So results of the business are analyzed and interpreted so that the users of financial accounting make some meaningful and sound judgment. The last one is communicating. So what are all the steps we have undergone that have to be conveyed to the end users with the financial report called financial statement, that help them to make some more decisions in their business. So next one is differences, different types of accounting. The first one is financial accounting. Financial accounting is that branch of accounting which involves identifying, measuring, recording, classifying, and summarizing the business transactions. So financial accounting is important for the business because it helps them to keep track of their financial transactions so that they can make sound decisions on how to allocate their own resources. So next one is cost accounting. Cost accounting is also a branch of accounting that is concerned with the process of ascertaining, controlling the cost of the product or services. It is an internal process used only by a company to identify the ways to reduce their expenses. It is helpful because it can identify where a company is spending its money, how to earn much more about with those resources, and where money is being wasted or lost, that can be find out with the help of cost accounting. Then the third one is management accounting. Management accounting refers to that the branches of accounting which is concerned with presenting the accounting information in such a way it helps the management um, in planning and controlling the operation of a business and in decision making. So next one is steps of accounting processes. So first one, we have to identify the business transactions and we have to analyze it. Then we have to record it in the way of journal, ledger, and more subsidiary books. Then the third step is we have to classify the transactions, which means segregation of transactions in the basis of nature so that it will be helpful to post it into the ledger. Then the next thing is we have to summarize it, that is includes preparation of trial balance and financial statements. Then we have to analyze and interpretation has been done. It includes an assessment of the financial reports and making some more meaningful conclusion. That meaningful conclusion to be communicated to the end users in the form of financial statements. So next one is advantages of accounting. So we'll talk about the advantages, means that starts from the performance of the business concern, right? So it provides the information about the finance performance during a given period of time. Profit, what has been earned by the organization, that can be presented here. Then it provides assistance to the management so that the management can able to compare it, and they can make some more sound decisions as well. And it helps in settlement of tax liability by keeping all the records in a systematic manner. That helps us to pay our tax and GST as well. So it helps in raising loans for bank assistance or any financial institution. They grant us the loan in the form of with the basis of the records what we have maintained in our business. So that way it helps to raise our loans, and also helpful in decision making. As I said, it is very much important for a business to make some more useful and soundful judgments. So for that, we have to make our accounting statement in a systematic manner. Then what are all the limitations we have with the accounting? First one is accounting is not precise. That is, it is not completely free from personal bias or judgment. Alterations of contents can be done, assumptions of values may be there. So those are all with the limitation aspect. The second thing is accounting is done on historic value of assets. When we have bought that asset in that period, what is the value of asset that has been entered in the books of accounts? We will not change it according to the current market value, right? So without depreciation as well. So that seeks that as another one limitation. Then the third one is it ignores the effect of price level changes. Accounting statements are prepared at historical cost, so the value of money are being ignored here. So next one is ignore qualitative information. Accounting records only monetary transactions, so it ignores the qualitative aspects. Then the final one is affected by window dressing. Window dressing here means manipulation in accounting to present more favorable position of the business than the actual position in order to get more investment or to attract more customers. Next one is uses of accounting. There have been two uses in accounting. One is internal and another one is external. In internals, we can say owners, management, and employees are comes under internal uses, whereas external uses are banks, financial institutions, investors, creditors, governments, and researchers and consumers as well. Next one is accounting standards. So accounting standard is the system of recording financial transaction with both numbers and text in the form of financial statement. It provides an essential tool for billing customers, keeping track of assets and liabilities, determining profitability, and tracking the flow of cash. The system is largely self-regulated and designed for the uses of financial information. We can say stakeholders for business owners, lenders, employees, managers, and why not customers as well. So stakeholders utilizes the financial statement to help make business lending and investment decision. So we have two standards. One has been provided by US, that is US GAAP, generally accepted accounting principles, and the other one is international financial reporting standards, IFRS. Okay, how accounting system works? An accounting system helps organization to maintain their accounts and record all the incomes and outgoings of the resources. As a result, they can track how much is being spent and how much has been earned. In a short, we can compare the use of organized system of accounting. It enables them to track their performance from financial point of view when companies record transactions properly. The documents prepared are accurate and they act as ready reference for the business. Whenever they need, they can retrieve and check for any particular transaction of a particular period. This account keeping system is, however, includes details about the purchase, sales, and liabilities recorded as expenses, income and expenses, and finding and accounts payable. As the data set is clear crystal, the details can be well represented via graphs and some more charts provided for a better comparative structure of the business to assess the end result, right? So this is how the managed accounting system works. Next one is types of accounting system. We have two types. One is single entry system and another one is double entry system. So single entry system means which is the traditional form of maintaining financial records. It records only either expenses or income. So that's why it is not accurate. So the tax authorities will not accept or recognize this system of single entry accounting. Okay, next one is double entry system. It is more accurate since it affects two different accounts at a time. So the preparation of financial reporting is easier and also reliable. So as well, the tax authorities will be recognized. Thank you.